Master these 5 trading rules and watch your trading improve immediately. A lot of beginner traders struggle with trading and keep losing money because they are missing one or all of these 5 trading rules that I am about to share with you. So we will start right away with the first trading rule, which would be have a trading plan. I know a lot of beginner traders that don't have a trading plan and they basically have no idea what they're actually doing, which will ultimately result in pure gambling. Having a trading plan will help you be consistent and a disciplined trader and not letting your emotions cloud your judgment during your trading. Meaning that a trading plan is a set of guidelines that help you make consistent decisions on your trading. Now here are the 5 main things that your trading plan should include. Number 1 would be a clear set of rules of when to enter and exit a trade. Because you don't want to be jumping the gun randomly and entering and exiting trades whenever you feel like it. You should have a set of rules which you will apply to your trading. So the second thing that you want to include in your trading plan is what assets will you be trading and in what time frames. So let's say that you want to trade gold. Well, then you write down the pair that you're trading as well as the time frames, for example, the weekly, daily, and 4-hour time frame for a day trader. Or if you're a scalper, maybe 30-minute, 15-minute, and 5-minute. That all depends on you. But you want to write down the time frames that you will be trading in as well as the sessions. So let's say that you usually want to trade during New York session or during London session. You should include all of that in that part of your trading plan. The third thing that you want to include into your trading plan is your overall trading strategy. So let's say that you are taking trades based off price action. That's what you want to write there. Maybe you take your trades based off supply and demand or smart money. Whatever it is, whatever your strategy is, write that down and write all of the details of it as well. The fourth part are the risk management techniques. So here you will be writing down your stop loss, your take profit, if you're going to be scaling in or going to be scaling out, and what position sizing you will be using. And the fifth part that you should include in your trading plan is your performance goals. For example, what is your percentage target per day, per week, or per month? What is your maximum drawdown per month or per week? Or maybe you have a pip target. How many pips do you want to gain per day or per week? So that's where you will write down all of that information. Now, a trading plan can be tailored to your own personal needs and goals, which is why you should always review your trading plan and seek to improve it over time. Now, I personally change my trading plan every 6 months, sometimes every year. So every year I look back and I see what I can change, what I can improve, and then I implement that into my upcoming trading plan for the next year. Now, the best advice that I can give you regarding this first rule is don't break your rules. You have a set of rules, stick to them, and if you stick to them in the long run, it will pay off. Now we come to rule number 2. Journal your trades. As traders, we are only able to improve if we learn from our mistakes. But how are we supposed to learn from our mistakes if we don't remember what trade we had yesterday or maybe the week before? And that's when your trading journal comes into play. A trading journal is a record of all of your trades that includes all of the details of the trades themselves. For example, the date of the trade, which pair you were trading, where your entry and your exit points were, what lot size you used, what confluences did you have to enter the trade in the first place. Then you also want to take screenshots of before and after the trade, so you also have a visual example of how the trade went. And finally, you want to review your trade by analyzing your emotions and reflecting on them and reflecting on what you can do better the next time. So by regularly reviewing your journal, you can identify patterns in your trading and seek improvements and adjustments over time. So in that way, you never stop developing yourself, but you only keep growing as a trader and becoming better and better day by day. So what I personally do is that every day before entering on the charts, before entering on a trade itself, I review my trades of the past days and I see how I performed. And now here, if I made some mistakes, I will write all of them down and put them somewhere where I can see those mistakes. And then the following week before entering in a trade, I will read that list and make sure that I am not repeating none of those mistakes. Because only in that way you can improve in the long run. Now we come to the third rule, which would be risk management. No, it's all good and great if you have a trading plan, you have a trading journal, but it will all be useless unless you have risk management in place. Now, risk management is an important part of a trader because it helps you to protect your capital and to maximize your profits as well. Now, when talking about risk management, I'm basically talking about using a stop loss, correct position sizing, and having a correct risk to reward ratio, which all of course depends on trader to trader. Now we come to rule number 4, which would be react and adapt. Now what I mean by that is that you should be open and flexible to the information that the market is giving you right now. So let's say that maybe your BS is short, meaning that you want to sell a currency, but then suddenly the market is starting to have a lot of bullish volume and change the market structure to a bullish structure, meaning that it stops you out because you were in for a sell. But instead of adapting to what the market was actually showing you, what you do is you jump the gun and you enter another trade on another sell just for that to also hit your stop loss. Now this is why being able to react and adapt on the market itself is super important. So you want to develop a skill where you will learn how to read the market and see what the market is actually telling you, instead of letting your emotions cloud your judgment and being fixed on one bias. And now we finally come to rule number 5, which would be accept losses. Now, losing is part of trading. There is no strategy out there that guarantees 100% win rate. And guess what? That is fine. We can still make money with trading as long as we are winning more than we are losing. For me personally, a trade is not lost if I followed my rules during that trade. So even if I lose the trade or if I lose some money, as long as I followed my trading rules, for me it is a win. Because I will then sit down and review my trade, and if I followed all of my rules, if I did everything right, then it will be my edge that will make me profitable in the long run. Now let's say that I lost and I broke some of my rules. Well, then I will review and sit down with my trading journal and see where I went wrong and write down all of the mistakes that I made to avoid repeating them next time. Meaning that once you learn to accept losses, trading will become much easier for you. Just make sure that you're only risking money that you are willing to lose. So that's it for today, guys. I hope you enjoyed this video. If you did, make sure to leave a like, comment, and subscribe. And if you're new to trading and you don't know how support and resistance work, then I'll highly recommend you to check out this video right here. And that way you will learn more about that and hopefully improve your trading. So that's it from me, guys. I'll see you on the next one. Peace.